Have you ever felt the pressure? That quiet, gnawing anxiety that says you're not doing enough with your money. You see the headlines, you hear the stories of people who picked the right stock at the right time, and you feel a sense of being left behind. So you decide to act. You open a brokerage account, you fund it with your hard-earned money, and you face a screen with thousands upon thousands of choices. A universe of ticker symbols, a galaxy of companies all vying for your capital. The advice you've heard echoes in your mind. Diversify. Don't put all your eggs in one basket. It sounds simple enough. But what does it actually mean? It means you, after working a full day at your own job, are now supposed to become a part-time expert on software, on healthcare, on industrial manufacturing, on consumer retail, and on banking. You are supposed to read the financial statements of dozens of companies, understand their competitive advantages, evaluate their management teams, and project their future earnings. You are supposed to construct a balanced, non-correlated portfolio, rebalance it periodically, and resist the daily temptations of fear and greed that whipsaw the market. It is a second job. And for most people, it is a job they are not trained for, a job they do not have time for, and a job at which they are statistically destined to fail. The immense difficulty, the sheer, crushing time commitment of trying to pick dozens of individual stocks is the single greatest barrier to successful investing for the average person. It is a costly market mistake that millions of people make every single day. They believe the path to wealth is paved with 1,000 tiny, brilliant decisions. But what if the secret was simpler? What if the path was paved with a single, great decision? This is the story of a final promise. A promise that you can achieve elite diversification, own a collection of the world's best businesses, and place your capital under the stewardship of a proven genius, all through a single transaction. It's the story of an idea so powerful and yet so overlooked that it has been the engine of the greatest wealth creation machine in modern history. This is the principle of buying into a family of great businesses under one corporate umbrella. This is the Berkshire Hathaway model. And understanding it will not just change how you invest, it will transform your entire relationship with your money, your time, and your financial future. We begin with the foundational concept, the very bedrock of this entire philosophy, the principle of the curated business collection. When you buy a share of a company like Berkshire Hathaway, you are not merely purchasing a stock. You are not betting on a single product or a single market trend. You are buying a fractional ownership in a vast, meticulously assembled museum of economic masterpieces. Each business within the collection has been hand-selected by a master curator, not for its short-term appeal, but for its timeless, enduring quality. It's the difference between buying a lottery ticket and buying a share in the entire casino. To truly understand this shift in mindset, from stock picker to business collector, we must travel back in time to 1972. Warren Buffett was already a successful investor, but his methodology was different then. He was a practitioner of what he called cigar butt investing, finding struggling, unloved companies trading for less than their liquidation value. You could pick one up for free, get one last puff out of it, and then discard it. It was profitable, but it was also messy and couldn't be scaled to manage large amounts of capital. Then, a man named Charlie Munger, Buffett's brilliant and curmudgeonly partner, began to influence his thinking. Munger's argument was simple. It is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. And the perfect test case for this new philosophy soon appeared. It was a charming, family-owned candy company based in California called See's Candies. The See family wanted to sell their business. They were asking for $30 million. Buffett and Munger took a look. The company was a gem. It had a beloved brand, intense customer loyalty, and a simple, understandable business model. Customers happily paid a premium for their chocolates, and the company required very little capital to grow. It was, in Buffett's words, a dream business. But there was a problem. The company's tangible assets, its factories, its inventory, were only worth about $8 million. Buffett's old cigar butt mentality screamed at him. Paying $30 million for a business with only $8 million in book value felt like madness. He countered with an offer of $25 million, and he refused to go a penny higher. The sellers held firm at 30, and for a moment the deal was dead. This is where Munger stepped in and changed the course of investment history. He berated Buffett. "You're going to lose this wonderful business over $5 million?" he argued. He forced Buffett to look beyond the cold, hard numbers on the balance sheet and see the invisible asset, the power of the brand. The See's brand lived in the minds of millions of customers. It was an economic moat that competitors could not cross. That brand allowed See's to raise prices year after year without losing customers, generating ever-increasing streams of cash. Reluctantly, Buffett agreed. They paid the $25 million they had initially offered, with the sellers eventually conceding from their $30 million ask. But the philosophical leap had been made. That $25 million investment in a California candy company became the cornerstone of the modern Berkshire Hathaway. That single decision was the proof of concept. Since 1972, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway. All of that cash has flowed up to the parent company, where Buffett and Munger could then reallocate it, using the profits from chocolate to buy pieces of railroads, insurance companies, and technology giants. They didn't just buy a stock, they bought a cash machine. This story perfectly illustrates the pillar of the curated business collection. You are not speculating on a ticker symbol. You are acquiring a piece of an economic engine with a durable competitive advantage. Now, why is this approach so psychologically powerful? It's because it acts as a direct antidote to some of our most destructive cognitive biases as investors. The two most prominent are the endowment effect and commitment bias. The endowment effect is our tendency to overvalue something simply because we own it. Think about the last time you tried to sell a used car or a piece of furniture. You likely thought it was worth more than the market was willing to pay. The same thing happens with stocks. An investor researches a company, let's call it Innovate Corp, and buys 100 shares. Instantly, their perception of Innovate Corp changes. It's no longer just a company. It's their company. They will seek out news that confirms their brilliant decision and ignore news that contradicts it. They are endowed with ownership, and it clouds their judgment. Closely related is commitment bias, also known as the sunk cost fallacy. This is our tendency to stick with a decision to justify our past commitment to it, even when presented with evidence that it was the wrong one. Our investor in Innovate Corp sees the stock fall by 30%. The business fundamentals have deteriorated, but instead of selling and admitting a mistake, they think, "I've already lost this much, I can't sell now, I have to wait for it to come back." They are committed to their initial thesis, and this commitment prevents them from making a rational decision. Buying a conglomerate like Berkshire Hathaway short-circuits these biases. Your commitment is not to dozens of individual businesses that you feel you personally discovered. Your commitment is to the curator, to the capital allocator, and their process. You are not endowed with ownership of Geico or BNSF in the same emotional way. You are a partner with the management team. This psychological distance is a superpower. When one of the businesses within the portfolio underperforms, you don't feel the same personal sting of being wrong. You trust that the master allocator is dealing with it, either by fixing it or by eventually selling it and redeploying the capital elsewhere. You have outsourced the difficult, emotionally charged decisions, insulating your portfolio from your own worst instincts. So how do we translate this powerful theory into a practical, applied mental model? We can call it the CEO of your own holding company mindset. This blueprint allows you to apply the logic of a conglomerate to your own investment strategy. Step 1 is to define your acquisition criteria. Just as Buffett has criteria for the businesses he buys, you must have criteria for the conglomerate you partner with. This isn't about the individual holdings, it's about the parent company. Is the management team shareholder-friendly? Do they have a long-term focus? Or are they obsessed with quarterly earnings? Are they rational capital allocators? Do they communicate clearly and honestly in their annual reports? You are choosing a corporate culture and a philosophy, not just a collection of assets. Step 2 is to perform due diligence on the CEO. In this model, the CEO of the conglomerate is your chief investment officer. For a retail investor, this means your primary research task is not to analyze 50 different companies, but to deeply analyze one or two management teams. For Berkshire, this means reading Warren Buffett's annual shareholder letters. All of them. They are a masterclass in business and investing, and they reveal the precise mental framework he uses to make decisions. You need to understand his philosophy so deeply that you can predict how he would react to different market conditions. This focused research is infinitely more valuable and manageable than trying to become an expert in a dozen different industries. Step 3 is to analyze the family of businesses. Once you trust the CEO, you can look at the assets they have assembled. Look at the quality and diversity of the holdings, both public and private. Do they have durable competitive advantages or moats? Does the collection make sense as a whole? You're not looking for a quarterly earnings beat from any single one of them. You're looking for collective, long-term earnings power. You are assessing the strength of the economic fortress they have built. Step 4 is the most important. Treat your investment as a permanent holding. When Buffett buys a business like See's Candies, he intends to hold it forever. As a shareholder in his enterprise, you must adopt the same mindset. You are not a stock trader. You are a business partner. Your goal is to let the value of this curated collection compound over decades, protected from the emotional whims that derail most investors. To fully appreciate the wisdom of this path, we must examine its opposite. We must walk the path of the 99%, the path I call the stock picker's delusion. This is the journey most retail investors take, and it is almost always a path to frustration and underperformance. It begins with a spark of excitement, a hot tip from a friend, or a segment on a financial news channel. The story is compelling, a revolutionary technology, a disruptive business model. Let's imagine our investor, we'll call him Tom. Tom hears about a new electric vehicle company. He doesn't really understand battery technology or automotive manufacturing supply chains, but he sees the stock price going up every day. He experiences a powerful fear of missing out. So he buys in, near the peak of the hype. Now the endowment effect kicks in, it's his stock. He tells his friends about his brilliant insight. He checks the stock price 10 times a day on his phone. It becomes an emotional roller coaster. When the stock goes up, he feels like a genius. When it goes down, he feels a pit in his stomach. He then decides he needs to, quote, diversify. So he buys a handful of other stocks he's heard of. A popular software company, a social media giant, a biotech firm with a promising drug trial. He now has a portfolio of 5 or 6 companies. He has no deep understanding of any of them. His portfolio is not a curated collection of wonderful businesses. It's a random grab bag of popular tickers. He has created his own mini conglomerate, but he is the unqualified CEO. He has no rational capital allocation strategy. His decisions are driven by headlines and market sentiment. Then, the market hits a rough patch. His high-flying tech stocks get hit the hardest. He sees his portfolio value drop by 25%. Panic sets in. The commitment bias that made him hold on during a small dip now shatters under the weight of real fear. He sells everything, locking in his losses. He vows to never invest in the stock market again. This is the path of the 99%. It is a journey defined by high stress, immense time consumption, significant transaction costs from frequent buying and selling, and ultimately, poor returns. It is the direct antithesis of buying a single, masterfully curated collection and holding it for the long term. Finally, we must connect this principle directly to the numbers on the page. How does owning a conglomerate translate into a tangible and massive financial advantage? The first and most obvious connection is superior diversification. A typical investor trying to build their own portfolio might end up with a dozen stocks heavily concentrated in 1 or 2 sectors, like technology. This portfolio is fragile. If that one sector falls out of favor, their entire net worth is at risk. A conglomerate like Berkshire Hathaway provides instant, professional-grade diversification. With one purchase, you own a piece of a leading auto insurer, Geico, a major railroad, BNSF, a massive utility and energy company, Berkshire Hathaway Energy, iconic consumer brands, See's Candies, Dairy Queen, industrial manufacturers, Precision Castparts, Lubrizol, and a massive portfolio of public stocks like Apple and Coca-Cola. This diversification across dozens of non-correlated industries drastically reduces your portfolio's volatility. A bad year for insurance might be a great year for the railroad. This stability allows you to sleep at night and stay invested through market cycles. The second connection is the quality and source of the earnings. The earnings of the wholly owned businesses within Berkshire are a stable, non-market correlated source of cash. The profits from BNSF's trains and Geico's insurance policies flow into Berkshire's coffers, regardless of whether the stock market is up or down that day. This constant stream of cash from the operating businesses is then used by the master allocator to buy more assets when they are cheap. A portfolio of public stocks only provides capital when you sell them or through dividends. A conglomerate creates its own internal river of capital, a powerful flywheel that fuels its own growth. This structural advantage, born from the simple idea of owning a collection of great businesses, is one of the most potent forces for long-term wealth building available to any investor. It is the key to transforming your portfolio from a fragile basket of bets into an unbreakable economic fortress. This leads us to our second pillar, an advantage so profound that most investors don't even know it exists: the unseen power of private ownership. When you look at a company like Berkshire Hathaway, you might see its famous stock holdings: Apple, Coca-Cola, American Express. But these public stocks are just the tip of the iceberg. The vast hidden bulk of the company's value lies in a sprawling empire of wholly owned private businesses. These are companies that you, as a retail investor, could never buy on your own. They are not traded on any stock exchange. Their value is not subject to the daily whims of market sentiment. They are the silent, powerful engines of the conglomerate, and owning a piece of them is a game-changing advantage. To understand the sheer scale and strategic importance of this, we must look to the darkest days of the Great Recession. In 2009, the global financial system was on the brink of collapse. Fear was everywhere. The stock market had been decimated, and the consensus view was that the American economy was in for a long and painful winter. It was in this environment of maximum pessimism that Warren Buffett made the biggest bet of his life. He announced that Berkshire Hathaway would acquire the remaining 77.5% of the Burlington Northern Santa Fe Railway, or BNSF, that it didn't already own. The total price tag was a staggering $44 billion. At the time the deal was shocking. It was an all-in wager on the future of the United States. A railroad is not a flashy tech company. It is a gritty, capital-intensive business. It's the circulatory system of the economy, transporting grain, coal, chemicals, and consumer goods across the continent. Buffett's reasoning was profound in its simplicity. He stated that investing in the railroad was a bet on the American economy, and he believed that bet would be a good one. He saw an unreplicable asset, an essential artery of commerce that could not be duplicated. There would be no new competitor building a transcontinental railroad across North America. BNSF had an enormous, unbreachable moat. Think about what this means from an investment perspective. As a retail investor in 2009, you could buy bank stocks that were on the verge of bankruptcy. You could buy technology stocks whose future was uncertain. But you could not, under any circumstances, buy a piece of a major American railroad outright. That asset class was completely inaccessible to you. By purchasing a share of Berkshire Hathaway, however, you could instantly become a part owner of the entire BNSF railway system. You could own a piece of every locomotive, every mile of track, every freight contract. You could participate in the fundamental physical economy of the country, completely insulated from the speculative frenzy of the stock market. Since the acquisition, BNSF has been a cash flow Goliath for Berkshire, generating billions of dollars in predictable, stable earnings year after year. This single anecdote reveals the core of this pillar. Conglomerate investing gives you access to elite, private assets that are simply off-limits to the public, providing a level of diversification and stability that a portfolio of public stocks can never hope to match. The psychological principle at play here is a powerful and pervasive cognitive bias, known as the availability heuristic. This mental shortcut describes our tendency to judge the likelihood of an event or the importance of a piece of information based on how easily examples come to mind. When it comes to investing, what's available, what's easy to recall? It's the public companies that are constantly in the news. Apple launching a new iPhone, Tesla's latest production numbers, Amazon's quarterly earnings. These stories are readily available, and so our minds naturally overweight their importance. We come to believe that the entire universe of great investments is contained within the S&P 500 or the NASDAQ. We focus all our attention on this brightly lit arena of public markets. But the availability heuristic creates a massive blind spot. It prevents us from seeing the vast universe of incredibly profitable, durable, and often boring private businesses that form the backbone of the economy. Think of companies like Marmon Group, a massive industrial conglomerate within Berkshire that makes everything from railroad tank cars to food service equipment. Or Precision Castparts, which manufactures critical components for the aerospace industry. These companies are not on the news, their names are not household words, but they are cash-generating machines with deep competitive moats. By investing in a conglomerate, you are systematically overriding your own availability heuristic. You are forcing yourself to invest in the unseen. You are partnering with a curator who spends their time searching for value in the places nobody else is looking. You are bundling the invisible, high-performing private assets with the more famous public ones, creating a portfolio that is far more robust and representative of the real economy than one based solely on what's readily available in the headlines. To make this concept actionable, we can use a mental model called the iceberg analysis. It's a simple, powerful way to see the true nature of the business you are buying. Step 1. Identify a target conglomerate you are considering for investment. For our example, we'll stick with Berkshire Hathaway. Step 2. Go to their most recent annual report and list their major public stock holdings. This is the tip of the iceberg, the part everyone sees and talks about. You'll write down Apple, Bank of America, Coca-Cola, American Express, and so on. You can easily find the market value of this public stock portfolio. Step 3. Now for the crucial part. Go to the section of the annual report that lists the wholly owned subsidiaries. This is the massive, hidden part of the iceberg beneath the water. You will list BNSF Railway, Berkshire Hathaway Energy, Geico, Clayton Homes, Marmon Group, Precision Castparts, Lubrizol, See's Candies, Dairy Queen, and dozens more. Step 4. For each of these major wholly owned businesses, do a quick high-level analysis of its industry and competitive position. You don't need to be a Wall Street analyst. Just ask simple questions. How essential is this business? BNSF is an essential artery. How strong is its brand? Geico's brand recognition is immense. What are the barriers to entry? The capital required to replicate Berkshire Hathaway Energy's network of utilities is astronomical. You will quickly realize that this is a collection of fortresses. Step 5. Compare the earnings power. In Berkshire's case, you will find that the earnings generated by this unseen collection of private businesses are colossal, often rivaling or exceeding the earnings from the entire public stock portfolio. This analysis fundamentally changes your perception of your investment. You are no longer just buying a basket of stocks. You are buying a stake in the core infrastructure of the American economy. You understand that a huge portion of your capital is now working in assets insulated from stock market panics, a foundational element for any entrepreneur or investor serious about professional asset management. Now let's contrast this with the path of the 99%, what we can call the public market arena. Most investors spend their entire lives confined to this arena. They believe the only game in town is the one played with publicly traded stocks. It's a crowded, competitive space where information travels at the speed of light and edges are incredibly difficult to find. They are all fishing in the same pond, and that pond is often overfished. When a particular sector, like artificial intelligence, becomes popular, a herd mentality takes over. Millions of investors, guided by the availability heuristic, pile into the same handful of popular stocks, driving their valuations to unsustainable levels. They are buying what is popular, not necessarily what is good or cheap. Their portfolios become a reflection of market sentiment rather than a collection of sound business assets. They are highly correlated with the major indices and extremely vulnerable to speculative bubbles. When the bubble pops, as it always does, these portfolios are devastated. The fundamental problem is that they are playing the game with a limited set of pieces. They can only buy what is offered on the public market. They have no access to the BNSFs or the See's Candies of the world, the durable, cash-generating private businesses that provide a bedrock of stability. They are perpetually stuck on the visible tip of the iceberg, completely unaware of the massive, stable foundation that lies beneath the water. Their wealth is tied to sentiment and speculation, while the conglomerate investor's wealth is tied to the real, productive capacity of the economy. The direct financial connection of owning these private assets is profound and can be summarized in one word: flywheel. Let's look at Berkshire's insurance operations, led by Geico. Insurance companies collect premiums from customers upfront and pay out claims later. This period between collecting the premium and paying the claim creates a pool of capital called the float. For Berkshire, this float amounts to over $100 billion. And the best part? It's effectively a zero-cost loan. As long as the insurance operations are run at a profit, this massive sum of money is available for Warren Buffett to invest for Berkshire's benefit. This is a structural financial advantage that is simply impossible for a retail investor to replicate. A portfolio of dividend-paying stocks gives you a small stream of cash. Owning an insurance conglomerate gives you a massive, interest-free river of capital. This is the flywheel in action. The cash from Geico's float and the profits from BNSF's railroad operations are collected at the parent company level. Buffett then acts as the master capital allocator, using that cash to buy more stocks when they are cheap, or to acquire another great private business. That new business then starts generating its own cash, which flows back to the parent, making the flywheel spin even faster. This self-funding growth engine is the direct financial result of owning a collection of private, cash-generating businesses. It is a powerful, almost unfair advantage that fuels compounding and is a direct path to building lasting wealth and achieving financial independence. You are not just an owner, you are a beneficiary of a system designed for perpetual growth. This brings us logically to our third pillar: the immense and often underestimated power of a master capital allocator. If a business generates cash, its leaders are faced with a critical and never-ending question: what do we do with this money? This is the essence of capital allocation. The options are few. They can reinvest it back into the core business. They can acquire other businesses, they can buy back their own stock, they can pay a dividend, or they can let the cash pile up on the balance sheet. The long-term success of any enterprise depends more on this single function than on almost any other. A brilliant operator can create a profitable business, but if the capital that business generates is then poorly allocated, the long-term results will be mediocre. By investing in a conglomerate run by a proven genius, you are outsourcing this most critical of all business decisions to the very best. You are hiring a world-class CEO for your capital. The perfect illustration of this took place in the summer of 2011. The financial world was still reeling from the 2008 crisis, and a new wave of fear was sweeping through the markets, this time centered on the stability of European banks and their exposure to sovereign debt. American banks, like Bank of America, were caught in the crossfire. Their stock price was plummeting. Investors were terrified that they were holding unknown risks, and there was a palpable crisis of confidence. At that moment, Warren Buffett saw not fear, but opportunity. He recognized that Bank of America was a cornerstone of the American financial system, and that its core business was fundamentally sound despite the market's panic. But he didn't just go online and buy shares like a retail investor. He used his position as a master capital allocator to craft a deal that was simply unavailable to anyone else. He called up the CEO of Bank of America and proposed a strategic investment. Berkshire Hathaway would invest $5 billion directly into the company. But this wasn't common stock. Buffett negotiated for preferred stock that would pay Berkshire a 6% dividend per year, a steady, guaranteed $300 million in income. On top of that, and this was the masterstroke, he received warrants that gave Berkshire the right to buy 700 million shares of Bank of America common stock at a fixed price of just over $7 per share, anytime over the next 10 years. The deal was a work of art. For Bank of America, the $5 billion investment was a massive vote of confidence from the world's most respected investor, instantly calming the market's fears and shoring up their capital base. For Berkshire, it was an incredibly low-risk, high-reward proposition. They received a handsome and secure income stream from the preferred shares, and the warrants gave them enormous upside potential if, as Buffett expected, the bank's fortunes recovered. And recover they did. Berkshire eventually exercised those warrants, netting a profit of well over $10 billion. This story is the ultimate demonstration of a master capital allocator at work. It wasn't just about picking a cheap stock. It was about understanding market psychology, structuring a brilliant deal, and deploying capital decisively when others were paralyzed by fear. By owning a share of Berkshire, you are a silent partner in that deal, benefiting from a level of financial acumen and executive decision-making that is simply in another league. The psychological principle that this pillar helps us overcome is the insidious Dunning-Kruger effect. This is a cognitive bias where individuals with low ability or knowledge in a particular domain tend to overestimate their own competence. In no field is this more rampant than in investing. Driven by a handful of lucky guesses or a bull market that makes everyone feel like a genius, many amateur investors develop an inflated sense of their own skill. They believe they can consistently pick winning stocks, time the market, and allocate capital more effectively than the professionals. They fall victim to their own overconfidence. The truth, backed by decades of data, is that the vast majority of people who try to actively manage their own money fail to even match the returns of a simple index fund, let alone beat the market's best practitioners. Choosing to invest in a conglomerate run by a master capital allocator is a profound act of intellectual humility. It is an honest acknowledgement of your own limitations. It's the recognition that capital allocation is a full-time professional skill honed over decades of experience, and that your time and energy are better spent focusing on your own career or business. By making this single, humble decision, you bypass the Dunning-Kruger effect entirely. You remove your own ego from the equation. You are not trying to be the star player on the field. You are hiring the best coach in the history of the game. This psychological shift from "I can do it myself" to "I will partner with the best" is one of the biggest leaps an investor can make towards achieving genuine, long-term financial success. How can we apply this in a structured way? We can use a mental model called the C-suite partnership framework. This model reframes your role from that of a stock picker to that of a board member selecting a CEO. Step 1. Acknowledge the CEO's role. Your primary task is not to analyze dozens of individual assets. It is to perform deep due diligence on the person or team responsible for allocating the company's capital. Your most important investment decision is who you entrust with your money. Step 2. Study their capital allocation decisions. This is where the real work is done. You must read the manager's past letters to shareholders. You must study their track record. How have they historically decided between the various options for their cash? Do they buy back stock when it's cheap? Or do they overpay for flashy, empire-building acquisitions? Do they have a clear, rational, and consistent framework for making these decisions? You are looking for a long history of intelligent, shareholder-oriented choices. Step 3. Evaluate their opportunity cost mindset. A great capital allocator is obsessed with opportunity cost. They know that a dollar invested in one project is a dollar that cannot be invested in another. They constantly compare every potential investment against all other options, including the option of simply holding cash. Buffett is famous for his discipline in this regard, often holding tens of billions of dollars in cash for years, waiting for the perfect fat pitch. Does the management team you're evaluating demonstrate this same patience and discipline? Or do they feel a constant pressure to do something with the money? Step 4. Align your time horizon. A master allocator thinks in terms of decades, not quarters. They are planting oak trees, not trading tulips. To be a successful partner, you must adopt the same perspective. You cannot invest in a company like Berkshire on Monday and expect to be rich by Friday. You are signing up for a multi-decade wealth-building journey. This alignment of time horizons is absolutely critical for allowing the allocator's skill to compound your capital effectively, which is the entire basis for long-term growth. Now let's look at the alternative, the path of the 99%. The DIY asset manager. This is the investor who believes they can and should be their own chief capital allocator. Their journey is often a chaotic and costly one. Their allocation decisions are not driven by a rational framework but by the emotional tides of the market. During periods of euphoria, like the dot-com bubble or the recent meme stock frenzy, they are driven by greed. They pour their capital into the most speculative, overpriced assets, hoping for a quick score. Their strategy is to buy high. Then, when the market inevitably turns and panic sets in, their decisions are driven by fear. They watch their portfolio value shrink, and they sell everything near the bottom, locking in devastating losses. Their strategy is to sell low. They are the captain of their own financial ship, but they are navigating by reading the headlines in the daily newspaper. They constantly churn their portfolio, chasing last year's winners, racking up transaction fees and triggering tax liabilities. They are perpetually reacting, never acting with a long-term plan. They have taken on the incredibly difficult job of capital allocation without the training, the temperament, or the time to do it effectively. The result is a portfolio in constant turmoil, a high level of stress, and financial returns that are a fraction of what they could have achieved by simply partnering with a master. The direct financial connection of having a master allocator at the helm is best measured by a metric called return on invested capital, or ROIC. This number shows how efficiently a company is generating profits from the capital it has deployed. A master allocator's primary skill is the ability to consistently find opportunities to deploy capital at very high rates of return over very long periods of time. We can see this concretely by comparing the long-term growth of Berkshire Hathaway's book value per share to the total return of the S&P 500 index. For decades, Berkshire's growth has significantly outpaced the market average. That outperformance is not magic. It is the direct mathematical result of superior capital allocation. Compounding your money at 15% or 20% per year versus the market's historical average of 8% to 10% creates a difference in final wealth that is not just large, it is astronomical. $100,000 compounded at 10% for 30 years becomes about $1.7 million. The same $100,000 compounded at 20% becomes nearly $24 million. That is the quantifiable financial power of entrusting your money to a genius. It is the mathematical engine of beating the S&P 500, and it is the clearest, most reliable path to true and lasting financial independence. Your investment is not just sitting there. It is being actively and intelligently put to work by the best in the business. This leads us to the fourth, and perhaps most structurally important pillar, the strategic advantage of permanent capital. This is a concept that is rarely discussed on financial news networks, but it is one of the most powerful secret weapons in a conglomerate's arsenal. It refers to a capital base that is stable and long-term in nature, one that is not subject to withdrawals or redemptions by investors. Most investment vehicles like mutual funds or hedge funds do not have this. They operate with temporary capital. If their investors get scared and want their money back, the fund manager has no choice but to sell assets to meet those redemption requests. A conglomerate like Berkshire Hathaway, on the other hand, operates with a massive, permanent capital base. The money from its retained earnings and insurance float is locked in. It never has to be returned to anyone. This structural difference creates a colossal strategic advantage, allowing the conglomerate to act with a level of rationality and patience that is impossible for other investment structures. The perfect anecdote to illustrate this is Berkshire's iconic investment in the Coca-Cola Company. The year was 1988. The market was still deeply scarred by the Black Monday crash of October 1987, when the Dow Jones Industrial Average fell by nearly 23% in a single day. Investor confidence was shattered. Fear was the dominant emotion. In this climate of anxiety, Warren Buffett was calmly doing his homework. He saw that the crash had indiscriminately punished all stocks, including those of wonderful, world-class businesses. He focused his attention on Coca-Cola. Here was a company with a globally dominant brand, a simple and profitable business model, and significant growth prospects abroad. The market, in its panic, was offering shares of this incredible business at a ridiculously attractive price. Over the course of 1988 and 1989, Buffett directed Berkshire to invest over $1 billion into Coca-Cola stock, eventually accumulating a 7% stake in the company. At the time, this was a massive, concentrated bet for Berkshire. He could make this bold move for one simple reason: permanent capital. He did not have to worry about a single client or investor calling him up in a panic and demanding their money back. He didn't have to fear a run on the bank. His capital base was a fortress. Now contrast this with a hypothetical mutual fund manager at the same time. That manager might have also recognized the incredible value in Coca-Cola stock, but as the market crashed, their investors would have been flooding their phone lines with sell orders. The manager would have been forced to sell assets to raise cash for those redemptions. And what do you sell in a panic? You sell your most liquid, highest quality holdings. They might have been forced to sell their Coca-Cola stock at the very bottom, not because their investment thesis was wrong, but because their business structure was fragile. Buffett, armed with permanent capital, was able to be, in his own famous words, greedy when others were fearful. He was able to use the market's irrationality as an opportunity, rather than being a victim of it. This ability to act as a provider of liquidity in a crisis, rather than a demander of it, is the direct result of the permanent capital structure. The underlying psychological principle that this structure overrides is known as myopic loss aversion. This is a powerful one-two punch of cognitive bias. Loss aversion refers to our tendency to feel the pain of a loss roughly twice as intensely as we feel the pleasure of an equivalent gain. Losing $100 hurts far more than finding $100 feels good. Myopic refers to our short-sightedness. We have a tendency to evaluate our portfolios far too frequently, daily or even hourly. When you combine these two, you get a recipe for disaster. An investor checking their portfolio every day during a market downturn is subjecting themselves to a constant stream of painful psychological triggers. Each downward tick of the stock price feels like a fresh loss, and the pain accumulates until it becomes unbearable. Eventually, to stop the pain, they sell. The permanent capital structure of a conglomerate acts as a system-level antidote to myopic loss aversion. The capital allocator, the CEO of the conglomerate, is shielded from the collective panic of thousands of myopic investors. They are not forced to react to short-term market fluctuations because their capital base is secure. They can afford to ignore the daily noise and focus on the long-term value of the assets. They can calmly and rationally make decisions with a 10 or 20-year time horizon, precisely when everyone else is panicking about the next 10 minutes. As an investor in the conglomerate, you become a beneficiary of this enforced discipline. The very structure of your investment protects your capital from the destructive consequences of mass hysteria. How can you, as an individual investor, apply this powerful concept? You can use a mental model called the Fortress Balance Sheet Assessment. This model helps you evaluate the quality and permanence of a conglomerate's capital base. Step 1. Analyze the capital sources. Go to the company's balance sheet and look at where its money comes from. How much of its capital base is made up of shareholder equity, particularly retained earnings? How much is from low-cost, long-term sources like insurance float? How much is from debt? A company with a high proportion of capital from retained earnings and float is a fortress. It owns its capital. A company heavily reliant on debt or short-term financing is much more fragile. Step 2. Check for a cash hoard. Does the company consistently maintain a large position in cash and short-term treasuries? For many companies, this would be seen as inefficient, but for a conglomerate built on the principle of permanent capital, this cash is not lazy. It is dry powder. It is strategic ammunition waiting to be deployed during a crisis when assets go on sale. Berkshire Hathaway's famous cash pile, often exceeding $150 billion, is the ultimate example of this. It is a war chest that allows them to take advantage of opportunities that no one else can. Step 3. Evaluate the redemption risk. This is the easiest step. For a publicly traded conglomerate, the redemption risk on its core capital is zero. The company never has to sell its assets to pay you back. Contrast this with any mutual fund or ETF you might own, where you must always consider the latent risk of the fund manager being forced to sell good assets due to outflows caused by other investors. Panic. Step 4. Adopt the no redemptions mindset yourself. When you buy shares in a conglomerate with a fortress balance sheet, you must make a mental commitment. You are now part of the permanent capital base. You will not be the weak link. You will not sell based on market fear. This psychological shift, where you view yourself not as a trader but as a permanent provider of capital, is crucial for unlocking the full benefits of this long-term wealth-building strategy. The antithesis to this fortress-like structure is what we can call the forced seller's trap, a pitfall that ensnares the vast majority of investment vehicles and individual investors. Imagine a popular mutual fund heavily invested in technology stocks. When a tech bubble bursts, the fund's value plummets. Panicked investors rush to redeem their shares. The fund manager, facing a wave of outflows, has no choice but to sell. They can't sell their illiquid, less desirable holdings. They must sell what they can, their shares in the high-quality liquid companies that they would otherwise want to keep for the long-term recovery. This forced selling at the bottom of the market crystallizes the losses for the remaining investors and ensures that the fund will not participate fully in the eventual rebound. They are trapped. Hedge funds, with their quarterly redemption clauses, face the same destructive dynamic. Even the individual retail investor often falls into this trap. They act as a fund manager with a single highly emotional client, themselves. When the market falls, their panicked inner client demands a redemption. They sell their best assets at the worst possible time, locking in their losses and turning a temporary paper loss into a permanent loss of capital. This is the direct opposite of the strategic advantage of permanent capital. It is a structure that is inherently fragile and pro-cyclical, amplifying the errors that fear and greed introduce into the investment process. The direct financial connection of permanent capital is its profound impact on the mathematics of compounding. The single biggest destroyer of long-term compounding is not low returns, it is interruption. Albert Einstein supposedly called compound interest the eighth wonder of the world, but the magic only works if the process is allowed to continue uninterrupted over very long periods. Being forced to sell during a major downturn is like chopping down an oak tree after 10 years because you are worried about a drought. You not only lose the tree, but you also lose all the future growth it would have produced. By creating a structure that is immune to forced redemptions, a permanent capital vehicle ensures that the compounding machine can run continuously through good times and bad for decades. We can illustrate this with a simple example. Imagine two portfolios, both starting with $100,000 and earning an average of 15% per year. Portfolio A is a permanent capital vehicle. After 30 years, it is worth over $6.6 million. Portfolio B is subject to investor panic. Every 10 years, it suffers a 50% drawdown, and the investor sells at the bottom, then gets back in a year later, missing the initial recovery. The interruptions are devastating. After 30 years, Portfolio B might be worth less than $1 million. The difference in the final outcome is staggering, and it is due entirely to the structural advantage of allowing the compounding to work its magic, uninterrupted. This is the ultimate financial benefit of permanent capital. It protects the compounding process, which is the true engine of long-term growth and passive income generation. We now arrive at our fifth and final pillar, the one that ties everything together and reveals the ultimate benefit of this entire approach, the profound simplicity of outsourcing genius. We live in a world of overwhelming complexity. When it comes to our finances, we are bombarded with an endless stream of information, advice, and options. There are thousands of stocks, thousands of mutual funds, thousands of ETFs. This explosion of choice doesn't empower us, it paralyzes us. The ultimate luxury in modern life is not more choice but more clarity. The conglomerate investing model offers that clarity. It is a powerful simplification, a way to achieve superior results with drastically less effort, less time, and less stress. It allows you to get off the hamster wheel of frantic activity and focus on what truly matters. And there is no better story to illustrate this principle of simplicity than the instructions Warren Buffett has left in his own will. For decades, Buffett has been the world's most famous and successful active investor. He has dedicated his life to the art and science of analyzing businesses and allocating capital. His vehicle for this has been Berkshire Hathaway. But when it comes to the money he will leave behind for his wife, his instructions are surprisingly different. In his will, he directs the trustee managing her funds to follow a remarkably simple plan. He writes, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund." He goes on to say, "I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers." At first glance, this might seem contradictory. Why would the greatest active investor of all time recommend a passive strategy? But the deeper lesson is incredibly profound. Buffett understands that there are really only two intelligent paths for an investor. Path one is to be purely passive. Buy a low-cost index fund that owns the entire market, and then do nothing. Path two is to be intensely active, but only if you have the skill, temperament, and time to be truly exceptional. For himself, he built Berkshire Hathaway, the ultimate active management machine. What Buffett is warning against is the vast, treacherous middle ground where most people live. This is the space where people try to be part-time active investors, where they try to pick a few stocks or time the market. This is the path of underperformance. The lesson from his will is a powerful endorsement of simplification. He is saying, either outsource your investing to the market as a whole through an index fund, or outsource it to an active manager of the highest possible caliber. Since a vehicle like Berkshire Hathaway is, in effect, a masterfully managed portfolio, owning it is the ultimate expression of outsourcing your active management to the absolute best. The psychological principle at work here is the antidote to what is known as the paradox of choice. This is the well-documented phenomenon where having too many options leads to anxiety, poor decision-making, and even paralysis. When an investor faces a screen with 5,000 different stocks to choose from, they are immediately overwhelmed. The cognitive load of trying to research and compare even a handful of them is immense. This often leads to one of two outcomes. The first is analysis paralysis, where the investor is so overwhelmed by the choices that they end up doing nothing at all, leaving their money to languish in a low-yield savings account. The second outcome is that they make a rash, simplified decision based on irrelevant criteria, like buying a stock simply because they've heard of the company. The conglomerate investing model elegantly solves the paradox of choice. It reduces a complex, multivariable problem, how to build a high-quality, diversified portfolio from scratch, into a single, much simpler decision. Is this one management team, this one capital allocator, trustworthy and competent? It collapses thousands of difficult decisions into one. This simplification is a powerful psychological relief. It frees up enormous mental bandwidth and eliminates a significant source of financial anxiety, allowing you to have confidence in your investment strategy without needing to become a full-time market analyst. So how can we implement this principle of simplicity in our own financial lives? The blueprint for this is the 80/20 portfolio construction. It's a pragmatic model that respects both the need for a sound, simple core and the human desire to participate in the market. Step 1. Commit to the core. You make the decision that the substantial majority of your equity portfolio, let's say 80%, will be invested in a single, high-quality, well-managed conglomerate. This single decision takes care of your diversification needs, your quality control, your access to private assets, and your capital allocation strategy. This is the bedrock of your long-term wealth-building plan. It is simple, robust, and requires minimal ongoing maintenance. Step 2. Satisfy the itch to pick. Many people genuinely enjoy the intellectual challenge of researching and investing in individual companies. The 80/20 model doesn't require you to give this up entirely. You can allocate a small, separate play money portion of your portfolio, say 20% or less, to this activity. Step 3. Set rules for the play portfolio. This smaller portfolio must be governed by strict rules. It is a learning tool and a hobby, not your primary path to financial independence. Its performance, good or bad, is not allowed to influence your decisions regarding the core 80%. You never sell from the core to add to the play portfolio. This quarantines your speculative activities and protects the bulk of your capital from any mistakes you might make. Step 4, and this is the most transformative part, reclaim your time. With 80% of your wealth securely managed by a master allocator, you can now reclaim the hundreds of hours you might have otherwise spent anxiously checking stock prices, reading analyst reports, and worrying about quarterly earnings. This reclaimed time is your greatest asset. You can reinvest it into your own career, into building your own business, into learning a new skill, or into your family. This is the ultimate arbitrage, trading stressful, low-return effort for high-return, high-fulfillment life activities. It's a model perfectly suited for busy professionals and entrepreneurs who understand that their primary wealth-building engine is their own earning power. To truly grasp the elegance of this solution, we must once more visit the path of the 99%. This is the path of the overwhelmed researcher. This individual has the best of intentions. They are diligent. They subscribe to financial publications. They watch the market news channels, and they spend their weekends hunched over a laptop, sifting through 10K reports and earnings call transcripts. They have a complex spreadsheet tracking 30 different stocks they own. They are constantly worried. Did their favorite tech company beat earnings estimates? What will the Federal Reserve do next? Is there a recession on the horizon? Their mind is a constant buzz of financial noise and anxiety. They are putting in the hours of a part-time Wall Street analyst, but for what? Despite all this immense effort, all this time and mental energy, their results are often mediocre. Study after study shows that the vast majority of active retail investors fail to beat a simple market index over the long run. They are paying a massive price in time, stress, and complexity for a substandard financial return. They are trapped in the paradox of choice, believing that more activity and more information will lead to better results, when in reality, the opposite is often true. They are working for their money in the most inefficient way possible. The direct financial connection of this pillar of simplicity is best understood through the metric of return on time invested. Let's compare two investors. Investor A, the overwhelmed researcher, spends 10 hours a week managing their portfolio of 30 stocks. Over a year, that's 520 hours. Investor B, the conglomerate partner, spends 20 hours a year. That time is spent reading the annual report and the shareholder letter from the master allocator they have partnered with. Now, let's assume that over the long term, Investor B's returns are actually better than Investor A's, which is a highly probable outcome. Investor B has achieved a superior financial result with less than 4% of the time commitment. Their return on time invested is astronomically higher. But the true financial benefit is even greater than that. What can Investor A do with the 500 hours they have reclaimed? If they are a consultant, a small business owner, or a skilled professional, they can invest that time into their own work, generating additional income that will almost certainly dwarf any small extra returns they could ever hope to eke out from frantic stock picking. The ultimate financial transformation comes from this realization. Your most powerful wealth-building tool is your own career and earning power. The optimal strategy is to focus your energy there, while your capital is efficiently and intelligently compounded by a trusted master. It is the separation of your labor from your capital, allowing both to grow at their maximum potential. This is the final promise: superior results, with less time, less stress, and more life. So let's take a step back and see what we've built. You came here today perhaps feeling the pressure, the complexity, the overwhelming weight of trying to build a portfolio stock by painful stock. You have now acquired a complete mental framework that fundamentally changes the game. You now understand the power of buying a curated business collection, not just a ticker symbol. You see the hidden advantage of owning a piece of elite private businesses that are off-limits to the public. You appreciate the immense leverage of partnering with a master capital allocator, outsourcing the most critical financial decision to a proven genius. You grasp the structural, almost unfair advantage of a permanent capital base that allows for rational, long-term decision-making in a world of short-term panic. And finally, you have seen how all of these pieces combine to create a strategy of profound simplicity, one that can deliver superior returns while freeing you to focus on your own life. This is not just a set of tips or tricks. This is a robust system of thought, a new operating system for your financial mind. You have invested your time here, and in return you have gained a tool that can serve you for the rest of your life. But it's crucial to understand that Warren Buffett's system, the entire philosophy of value investing, is not a single pillar. It is an interconnected latticework of mental models. What you have just mastered, the conglomerate model, is one of the most powerful and foundational pieces of that structure. But it is still just one piece. It is a critical hub, but to make it truly unbreakable, you must understand how the other models connect to it. How does the concept of a margin of safety inform which conglomerate to buy? How does the circle of competence model prevent you from making a mistake even when following a great leader? These are not separate ideas. They are interlocking gears in a single powerful machine for wealth creation. The video that is now appearing on your screen is not just another video. It is the next piece of the map. It is the link that connects the powerful hub you have just built to the next critical node in the network. It holds the key to another fundamental principle, the one that Buffett himself has described as the 3 most important words in investing. Mastering the idea you learned today gives you a fortress. Understanding the concept in this next video teaches you precisely when and at what price to buy that fortress. One without the other is incomplete. The choice to click is not about watching another piece of content. It is a decision about who you want to become. Are you someone who collects interesting ideas, or are you someone who builds a complete, functional mental arsenal? The path to mastery requires that next step. Continue your ascent. Complete the machine, click and discover the missing link.